Hope is not a strategy. That's a line from today's episode that stuck with me. Because at FinTech, too many partnerships actually build on hope. Hope that the customers will come, hope that the product will fit. But the companies that actually succeed, they do the work upfront. Today I'm joined by Jas Shah, a FinTech product consultant who has worked on both sides of embedded finance, from inside big banks to advising FinTechs on how to become embedded ready. In this conversation, we explore what separates successful embedded finance partnerships from the ones that never take off, why the customer so often gets forgotten in these deals, and how companies can test the embedded strategy before going all in. We also dive into agentic finance and why Jas believes AI agent will transform SME lending by replacing brokers with smarter, faster, and cheaper alternatives. My name is Lars Markel, and this is the Embedded Finance Review podcast. Every 2 weeks, I'm interviewing the builders and shapers of embedded finance. And a quick reminder from my side, an Embedded Finance Review, I publish weekly newsletters, bi-weekly podcasts, and host in-person and virtual industry events. You can find all of this on my website, embeddedfinancereview.com. In addition, I work with non-financial brands, infrastructure providers, and banks to understand, design, and launch the embedded finance products. If you are interested in working with me, visit my website and reach out. And now, let's dive in. Hey Jas, welcome to the podcast. How are you doing today, and in what part of the world are you actually located right now?
Hey Lars, great to be here. I am in London, which is sunny, even though it's December. And yeah, great to be on the pod and great to speak with you.
Yeah, thanks for having me. At the time of the recording, I'm actually in Mumbai, so it's pretty sunny over here as well. Looking at the weather in Berlin, it seems pretty cold over there, but glad to hear that you're having some sunny days in London as well.
The rare sunny day in London. Yesterday was just all rain, so yeah, nice balance.
Indeed. And now is also maybe then a good time to talk about embedded finance and dive into that rabbit hole. Obviously, with your background, you have seen the machine from the inside. As a product consultant, you have spent times on both sides of the value chain, working with companies, building embedded finance products. Maybe to kick things off, is there something from your personal experience that you've seen that differentiate companies who are doing an amazing job compared to those who are doing a poor or maybe just an average good job?
Yeah, I mean, I think the companies who really think about I've spoken about using Klarna as an example of a kind of torchbearer for what good embedded finance looks like, because Klarna's implementation of embedded finance is kind of a three-party win. It's a win for the embeddee, so for merchants, for retailers who want to increase conversion, there's a benefit there. For Klarna, obviously, they get customers, they get, there is revenue, and obviously they can offer new products and they get the consumer behavior there and they get consumer data. But then for the consumer, they also get the win of being able to get through checkout and having an option to check out where they might not have the funds, and they don't have to find external sources for finance, and they get basically point of sale finance to complete their transaction. So for me, just generally, the folks who do it well look at all three parts: the embedder, the embeddee, and the customer. And those are the ones where you see it right. And I always use Klarna as an example. It might not be the best example to use at all times based on what they do and some of how they do things. But in terms of the execution of the product, I don't really think there's much to fault there.
Got it. And it's a good example. When you say this is an example where they have a hit on all the three different areas, is there a common one when companies miss somebody? Is there, let's say, a usual one that gets often forgotten from these 3 points? I mean, it seems pretty straightforward, but I guess the devil lies in the details, right?
Yeah, funnily enough, I think the one that gets missed the most is the customer. But this might be my little bias skew and the lens that I look at things through, because I'm always looking at, well, what's the benefit to the customer? Whereas a lot of embedded finance partnerships are, let's say, a bank and a fintech. A bank really wants to increase their share of SME lending. They have a big pot of money. They're struggling to lend the funds out. They see this fintech. Oh, this fintech's got, high growth. Their SME numbers are growing. Their dispersion rates are great. Their onboarding and customer acquisition rates are great. That's what we want. That's what we're missing. Let's do the partnership. They don't look at, okay, is there alignment with our ICP and their ICP? Is there a gap between where we're good at serving customers versus where they're great at serving customers? And is there an overlap there? And I think that's the bit where, strangely enough, the thing that is critical to the success of an embedded finance partnership, the customer acquisition, adoption, and usage, that's the bit that's not really looked at from my experience.
It definitely, like when you said at the beginning, it does sound like funny to me in a way. But now that you explain from the different way, I think it actually, and probably for other people in the industry as well, it kind of like sounds very familiar, right? Where you have this, maybe this very interesting partnership, maybe from the fintech perspective or the enabler who can now partner with a big bank and they want to go after their own clients and you're like very excited about it and you push forward to it without really questioning if there is really the fit for the ICP, as you said, right? And that's very often maybe both sides don't even want to verify that because the answer, no, it's not there, might even not the one that some people want to really hear. They rather want to push for it and make it work somehow. And obviously you can always argue customers will accept that maybe in one way or another, even though the benefit is not so great. I mean, that's a line you can tell yourself for that period, right?
Yeah, exactly. And I think part of it is down to the partnership itself and the way the partnership evolves. Like you said, it's, sometimes it's two organizations, maybe the two organizations already know each other through different circles. Like you and I know how this works. Some of these things happen just organically, but some is like, oh, I know so-and-so who used to work at this company. Now they work at, head of SME lending at NatWest. That's how some of these partnerships evolve. And like you said, maybe it's just we don't really want to go too deep into this. Maybe just if we build it, then customers will use it. And you don't look at, well, actually, who are those customers? What are they currently doing in both those organizations? And if we come up with an embedded proposition, does embedded actually solve the problem for the consumer or not? And again, I'm skewing towards big bank versus big bank fintech partnerships. But if it's a big bank, look, the big bank has a lot of customers. Is the fintech embedding the fintech's product into our stack? Does that help serve those customers in some way? And I think, like you said, sometimes it's, oh, let's just build it and hope that things come through. But as someone said recently, I think it's Alex Johnson on one of his Substacks, hope is not a strategy. I think there's a lot of hope in some of these partnerships, especially embedded finance partnerships. But yeah, hope is not a strategy. The point of the partnership discussion should be to remove any mention of hope and to actually be tangible with, how are we going to acquire customers? Oh, let's hope they come. Nope. Really, how are we going to acquire them? What's the base? What are they using day to day? How is this going to accelerate the time to value for them?
Yeah, and maybe also another analogy is like it's a little bit like Schrodinger's cat, right? Like while you build it, you don't know what's going to be under the box when you lift it. So you kind of like tell yourself, it's going to be fine. It's going to be fine. And obviously the bad moment can be postponed until later.
Yeah. Yeah, I like that analogy.
And I mean, obviously you as a product consultant, I guess like one of the things you described right now and like really, really important is getting the customer demand right. And you touch on a little bit like, okay, you have to ensure that in that example, the bank working with the fintech, the ICB needs to be somehow aligned. Maybe we can like go a little bit deeper into that. Like, is there more that should be ensured to verify that these products will actually be a success? Like, are there like some practical examples maybe you have done in the past to ensure that the product will be a fit? Is it purely like customer research, or how do you go about that?
I mean, it starts with customer research. I think every successful project I've worked on has started with 1 or 2 sprints, and that could be a month or 2 months of very deep customer research. Who is going to be the user of this? If it's a greenfield product, who's going to be the user of this product? What are we trying to solve for? How do we solve the problem? How big is the problem? Like, what's the TAM? What's the SAM? All of this. I call them, they're fundamentals, because if you don't have them, you're always in a deck, you're always kind of spinning them up. But really, if you have all this research, it's always something to refer back to. So I think customer research is fundamental, but also just testing the market. And you can test the market. For example, if there's an embedded finance partnership with, I don't know, again, a big bank and a fintech, you can always test the market by starting with a referral mechanism, for example. Like, you don't go full embedded on day one. You go, right, we are going to ring fence 1,000 of our SMEs. We know that they are open to invoice finance, for example. We don't have an invoice finance product for this level of SME, but this fintech does. So why don't we just offer this as a kind of referral partnership, see what the uptake is, see what the click-through conversion rates are before embedding it. And it's such an easy way to collaborate and test the market without going full blown. And like, again, others know, have worked in the space. Going full blown embedded is a lot more complex. You are trying to embed technology as well as product and strategy. Whereas this referral is almost like a kind of decoupled test of, will consumers use it? Is there adoption? Is there a need? What are the margins? Like, what are the costs? How do we make money from this proposition? And if it doesn't work, then you could say, oh, look, we did a proof of concept. This is the test. It didn't work. And if it does work, you go, right, what's the next step is to reduce friction even further and actually build it into like an accounting platform straight for the customer, straight into the customer's bank account. We give this option. But the first step is test the market, do the research, test the market.
And I totally get your point. I mean, obviously, we here in the embedded finance bubble always make sure to say like, okay, referral partnerships are not really embedded finance. That's not the magic of embedded finance. But obviously, I think everybody who says that, and definitely correct, also agree with, there's obviously a point of using referral to testing that. And I've seen it personally as well, where referral partnerships or anything else for that matter, what you can do to build up confidence on either side that this is the right direction can help so much with getting momentum on either side of the parties, because so often I've seen teams on a non-financial brand side who have so many unknowns about the whole product, about the offering, about the impact, about the details and so on. If you can start slowly and kind of can show them data, you can show them customer usage, customer experience, they kind of get hooked on this completely different, and their commitment and engagement with the product or with the building of a product after this is completely different than when you leave them in the unknown and you kind of tell them, no, trust me on that one, it's going to be fine. And I think this can mean in terms of like speed of development and execution, a big impact.
Yeah, 100%. Yeah, and again, hope is not a strategy. So this helps with reducing the hope as well, building a proof of concept. And I agree, referral is not embedded finance. But like you said, it can be step one to a more complete, cohesive, and successful embedded finance proposition.
And coming back to what you said earlier, the partnership of the bank and the fintech that was initiated by, I think we were describing it maybe, I think there's some context over there or some networking over, not network overlaps, and that's how opportunistically maybe the two parties started to engage with, which I guess is not an incorrect approach. Obviously, what you said is the research, the understanding needs to be done so to actually make sure it's actually adding value for both sides. But it can be one channel, but obviously a lot of players out there who maybe don't have this network. I mean, if you're working with, let's say, fintech companies or non-financial brands for that matter, who are looking for a bank, for enabler, for anything like this, have you seen any work? Is there any kind of like, let's say, to kick off that segment, any kind of like high-level tips or suggestions for somebody to find that right party, while it might be a little bit hard to find the right one?
There are a couple of tools. I think Naya One, I think, do have a route to get to Sandbox, which is a way to kind of surface your product to a more enterprise, bigger traditional banks. But there are a bunch of accelerators and programs. So the FCA AI Sandbox, I think that's a good way to get exposure. FinTech Scotland, FinTech Wales. There's a bunch of accelerators where banks participate, and they mainly are participating to see, okay, what's the market doing? But with that lens of, okay, can we buy this fintech that's coming up, or can we use their product in some way? Because lots of the banks, especially in the UK, they have specific challenges that they've started to publish internally, where they say, look, we've got these challenges and we've got these opportunities, and we need to make sure that everyone across all these teams understand that there are different ways to solve the problems. We can build the products ourselves. It's a lot slower, again, just generally. We can acquire another company, or we can embed, or we can partner with another company, or we can embed another product into our stack. So these banks are always looking to solve their own problems in different ways. Embedded and partnerships is one way, but you have to be discoverable. It's almost like increasing your SEO presence on Google. It's like, how do you do that as a fintech for banks? And that is, maybe it's a bit of PR, maybe it's press, maybe it's just going to networking events, but also it's like being listed on accelerators, being part of cohorts that are doing things in the sandbox, that are doing really interesting things with AI. I think that's a way to get exposure, to be on the radar.
And I guess like how the way you're saying it, right? It sounds like there's not really let's say, that one silver bullet, how like everybody will definitely achieve it. I guess also, I mean, you spoke specifically about British banks. I mean, correct me if I'm wrong. It might be now probably a little bit easier to get in touch with the right person, with the right team or somebody than maybe 10, 15 years ago. So obviously with all the fintech development and everything else that happened in the past years, it's got a little bit easier, but I would probably still assume, I mean, like you might have more exposure to that, but it's still not easy to convince someone. I mean, even though the banks are participating in the accelerators, even though they're doing certain things, that's still somehow, I mean, from my experience, at least in Germany, very often, let's say, the more innovative team who are kind of like doing some kind of activities, but then kind of getting over the team to the really right department to make things actually work is still a mystery box sometimes, right? And I guess the reason you mentioned a lot of these different things is like you have to do a lot of the things to be searchable, findable, but then also the right timing, the right messaging, the right contact, all of that also still needs to find a place to be actually able to gain that relevant network contact.
Yeah. I mean, timing, you just touched on timing. Timing is one that's so underrated. I mean, TSB is going to Santander are acquiring TSB, or TSB is being merged into Santander stack. So if you'd gone to TSB and had an embedded proposition that was perfect for TSB 7 months ago, if you'd gone to them 5 months ago, they probably would have said, look, the timing's not right. We don't really know what the future holds for us, so we're going to have to put it on pause. But if you'd gone to them a year ago, you might be in there already and you might be generating revenue, and it might be very difficult to decouple the product from the stack. And maybe then that means your company is worth 10 times more because now it's part of the Santander group. So I think timing is really interesting. And again, just to touch on the point on the black box, I worked for Citibank for 6 years. I sometimes didn't know within the organization who the best person to talk to about a specific thing was. So I used to sometimes work with treasury in the fixed income team. And even I was like, there's 30 people who work in the department. I don't really know who the best person is. So for someone external looking inside, I think you might think, I'm connected to the head of fintech partnerships and I'm working on this kind of product. But sometimes the head of fintech partnerships doesn't exactly know who the perfect person is. They have to go do work to find it out. So that's another consideration, is that black box. Sometimes the black box is a black box for the person inside the organization as well as the person outside.
Yeah, I guess for everybody who also worked in or touched with teams who working on B2B sales is also, what is the right number? I forgot it, like 6-7 contacts you need in a certain organization to be actually really able confidently to say if this could be a fit, yes or no, just because you've spoken to 2, 3, maybe even 4 people and they all told you no, this is definitely nothing for us, doesn't mean it's actually the case. I guess the number maybe for a bank is much larger than that, but I think even for a normal sized fintech corporation, 6, 7 is still the number. Under that, it doesn't make sense to have any kind of don't have any confidence in a workout. And when we spoke before, also message, I remember you touched on this topic, getting fintech companies embedded ready, and that's some topic I find extremely exciting. So maybe just to recap what we spoke about here is that I think you might use specifically the example of lending companies, direct lending, I guess maybe very often also lending to SMEs who are now thinking about going through certain new channels to attract completely new customers, right? I think you see that in Germany quite often, I guess also in other countries, in the UK maybe as well, a quite common theme where you're kind of looking for the new channels, right? Customers, or let's say businesses who interact with your potential customers already. Maybe you can share your view on this trend. Is this increasing right now? Why is that happening? And then we can go in a little bit deeper from there.
Yeah, I mean, embedded ready, I think it starts with understanding what your product does very well and understanding the customer base. So those are the two core principles of being embedded ready. First means probably introspecting and going, look, what are we great at versus the maybe competitors in the space? And what does our customer base look like? Because then you could go look externally at partners who either complement or you're helping to bring a new customer base to that organization, or you're supplementing their existing customer base with an ICP match. So that's the first thing to look at, is being embedded ready is really understanding what does your product do. And I've done this before by just going into an organization, just asking a random salesperson, okay, if you were going to sell this product to me, how would you sell it? How would you describe the product? And how would you describe your ideal customer? And if you can't do it, I think it's a challenge. And I think you need to maybe look, introspect again, and then publish the core principles of what the product is, what it does, and who it's for. So that's the first step. Then it's really looking at, okay, what parts of the product are maybe unique that can be, I just say wrapped in an API. I think that is a very loose terminology, but I think most people will understand what I mean is, for example, are you looking at your product and saying, well, actually the onboarding journey can in itself be something that can be embedded in another product, easily usable via an API, technologically it's ready. And that's another, like looking at technological readiness is another factor. And again, I've looked at products and organizations where I've just asked, look, if I set up a bank now and I wanted to call an API to do this thing that you say you do, would I be able to do it? And if they say no, or if they don't have documents and even an API library, which you could spin up quite easily nowadays, then I think that's another flag. And it's another thing on the checklist that you should be like, well, that is the approach that most organizations are looking for. They are looking for like, what is your API? Send me your API key and send me your API documentation and give me a sandbox environment. And I'll just spend a couple of days, I'll give it to my devs and they'll just test. Like, what can I'm going to ping it. I'll call some requests. I'll see what data I get back. How usable is the data in this current format? What do we need to change? When you look at all the big successful FinTechs, forget embedded finance for a second. All the huge successful FinTechs have APIs that are easily accessible and that someone could basically ping and pull data from almost instantly. Stripe, Plaid, Marqeta, all of the big infrastructure players work in that way. And it's successful for a reason, because you could get clients easily, you can integrate your product, you can see the value of the product instantaneously. And it's another thing that I think people should think about, not after the fact, think about it as you're building your product is, right, we've got these modules, let's say onboarding, risk assessment, finance disbursement, in-life management, product closeout. How could these modules be like layered with different APIs and then maybe one API that works all together, that someone else could ping it and actually see the value of your product. And then you come up with a commercial arrangement that say, look, per API request is this, this, and this. I think these are a couple of things that I say people need to look at to become embedded ready.
Got it. And I think obviously some of the company names you just mentioned, some of them have this, let's say, API approach or being the enabler, being the infrastructure provider already by definition. That's what they're doing. But obviously there are quite a few companies already who start not direct to consumer, but like direct to SMEs, where they kind of try to grow with a direct to SME offering. Is it lending? Is it invoice financing? Is it any of that? And then obviously, I think the realization that many fintech companies that very early in the whole fintech wave, it's really hard to acquire all these company or customers and all of that. So isn't there anybody already in the market that we can like partner with? And obviously now in the embedded finance world, it's not so much a referral agreement anymore, which was probably more popular back in the days. Now it's about like, oh, can you not offer my loans to your customers on your platform, right? And then the question now that I'm having is like, again, if you're a company who is by default, by definition, an enabler, that's a thing of that's your core. But if you are, let's say, giving out loans today to SMEs directly, and now you're thinking about the embedded approach where you want to like spin out an API and then maybe an accounting tool provider or other kind of like software as a service company should integrate, to offer loans to their own customers, that requires probably strong organizational shift as well and understanding why this makes sense and have everybody on board, or how do you see that?
Yeah, I think it needs to be explainable. It needs to be, look, we're building an API strategy for this reason. But usually, if you're thinking about embedding or embedded finance or making your product embedded ready, there's usually a reason. It could be, look, we're going through this new phase. We've tested the product in the market. We've got good growth. But actually, to get real growth, it's maybe not about building out a sales team, doing a ton of marketing, which increases customer acquisition cost. The approach now is, where do the majority of customers already lie? Where do they already live? And do we want to pull them away from where they currently live? The odds are probably not, because if you're a finance provider, you're probably not a full-blown bank and you're not doing full-blown bank or accounting services. So where do they live? And how do we embed our product into where they already live without changing their behavior? Because changing consumer behavior is a long, very time-consuming and costly road. if you want to do it and you commit to it, it's probably 5 years maybe to really change consumer behavior and pull them into your product, and a lot of investment. So instead of doing that, where do they currently live? And I think that's where the strategy and the internal comms around strategy needs to be. Like, we're making ourselves embedded ready because most of our customers live in these 3 big banks. And the odds are we're not going to pull away 30 million customers from these 3 big banks in the next 5 years. So we have to at least make them become familiar with our products. And if we do want to attract them over time, we can. But first, we just need to make them aware of the product and get in front of these customers. And the customers already live there. Let's not try and make them move house. Let's just go where they are. And then maybe down the line, the strategy changes. But yeah, it's usually a customer acquisition revenue decision. Really, that's what I've seen about embedded finance is we want more customers, we want more revenue, we want more exposure. The additional benefit sometimes is the partnership. Like a small fintech partnering with a big bank is great because you can put the big bank on your masthead and say, we've partnered with Bank X, like BBVA or Santander or Lloyds or Barclays. That's great social proof for every other bank on the street to say, well, if they've partnered with Lloyds, then they must be
here.
Yeah, or they must have like a great team to be able to do the work to implement the product, because implementing a product in a bank isn't easy. So again, the strategy needs to obviously be explained like you've touched on, but also the benefits don't go beyond revenue, customer growth. Sometimes it's just social proof is a great marketing tool in itself.
Yeah, totally agree. And obviously people who follow you, who read your newsletter and follow the industry know that there is a big topic as well. Obviously industry is thinking quite a bit about, and you have also written about, which is agentic finance. Obviously quite a bit of a buzzword. There is, of course, some overlaps to embedded finance, but of course also in, let's say, the pure fintech world, quite an important theme. I think people would be mad if we at least didn't speak a few minutes about that. So maybe you can give us a little bit about your definition of agentic finance and why do you think this is currently such a hot topic, and then we can take a little bit deeper from there.
I guess a definition of agentic finance: software that can understand financial context, make decisions within defined guardrails, and then execute actions on behalf of a business or consumer. That's the definition. The guardrails can be consumer preferences, price, financial product. Financial context is what situation is the consumer or business in. And I think when we talk about this, I think the article I wrote a few months back was around the buzz of agentic commerce, and I was kind of looking at it through a personal skeptical lens of, I don't think agentic commerce, having agents transact on behalf of individuals is solving that great a problem. The greater problem I see where this applies is in agentic finance, where there's less of a behavioral attachment to finance from SMEs. Often the objective of SMEs when they're going through a lender or going through a bank or getting finance through an embedded proposition is just getting the finance. They just want to improve their cash flow. They don't want invoice finance. They want to improve their cash flow, or they want to invest in marketing, or they want to grow a factory. So it's very different to the commerce experience from consumers, where consumers are, there's behaviors, there's like preferences, there's fashion and lifestyle. SMEs just want something within a given time period and at a given rate. And that's where agents that can scan the market, that can understand the individual's financial context through an accounting service provider, for example. They know the consumer's desire to take out finance within a given time frame. They know the consumer's preferences on products. The agent can go scan the market, find the best deals, go through onboarding automatically, and then surface 4 options to an SME who could just execute. That's effectively what most SME lending sales people do. That is effectively replacing the job of that SME sales broker, of which that is that core layer. Actually, when you look at the SME lending market, all of the SME lenders I've spoken to and a couple that I've worked with, they say most of our big deals happen through brokers. Brokers still take a fee. And SMEs don't necessarily want to speak to brokers on a regular basis. They go through brokers because they know brokers can give them the best deal and the best product at the best rate. If you replace a broker with an agent and you get lower fees, more options, and the SME could literally see the options and then execute with a click of a button, or even autonomously, I don't think we'll get there within the next year, but potentially autonomously over the next couple of years, and the cash just lands in your account within a few hours, that's the utopia. And for me, agentic finance solves a bigger problem than agentic commerce.
Got it. And I just wanted that you did it in the last part of your answer, but I wanted to make the connection to the SME broker and also specifically taking like a practical example. I mean, you know it as well that my wife has this food startup in Germany where she sells Indian snacks. And obviously, as a small company, always looking for ways to finance the next container of products coming into the harbor and selling it over there. And obviously by now there is like so many different financing models out there, right? And it's like working capital finance, is it something else, and different providers, different solution, and scouting all of that. And in a way, yeah, what you described right now, it actually does sound like at least a big challenge for SME brokers, where a company like hers can say, like, this is all my data, this is all where I stand. What can I do, or what are my options to, or not just my option, like find me the best option to finance the next container of X thousand euros. And maybe don't make it everything obviously autonomously, but do the onboarding, prepare everything so I can then decide at the end of it if I want to pull the trigger, yes or no. And obviously this sounds for many, I mean, this is not specifically the SME lending case, but I guess also other cases in finance or fintech where this can be a big benefit.
Yeah, I mean, that's the utopia. And I guess I would ask yourself and your wife, what platforms do you use most to manage? And this is where I go back to discovery. It's what platforms do you use day to day to manage your company, to manage your business? The odds are, and this is why sometimes I think the fintech to bank embedded finance partnerships are good, but they're not, again, for me, they're not the best case scenario. I would say you use your accounting platform more than you use your business bank account, as in going into your business bank account. So actually, for me, this is where agentic finance microscope should probably, or lens should probably start looking, is what are ASPs doing over the next couple of years, like Sage, QuickBooks, the rest of them all disappeared. But what are they doing? Because they have access to accounting data. They see accounts receivables, accounts payables. They can connect all your accounts, other accounting data, see your tax liability, see your VAT, see your corporation tax, and they can see cash flow gaps as well. And then you just need to say, oh, in addition to this cash flow gap, I'm actually looking to invest 20,000 because we want to, basically, we're looking to expand. At the moment, they don't have that context. ASPs, just as pure, flat, let's call them a glorified, really smart spreadsheet, don't have the context. If you give them the context, which is the financial context I talked about in the agentic finance definition, if you give them the context and they build the guardrails, but they also connect the different options for finance. So for example, Sage connects to Alika, Lloyds, Barclays, Satago, Iwaka, all these different finance options. And then the best one is surfaced to yourself and your wife at the point at which you request it. That solves a bunch of time for you. It probably saves a bunch of money for you as well. And for the finance provider who's embedding it into Sage's desktop or cloud version of their account service software. And it's a no-brainer. Again, that is the win-win-win. Win for the embedder, win for the embeddee, win for the consumer. That's what I think the agentic finance world will look like in a few years.
That's a great connection to the beginning of the episode. I do want to make one more comment before we close it off here. I think that I just spoke to just like a couple of days ago also with somebody about all these platform marketplaces that offer now like pre-qualified loans based on the data, right? You have like the restaurant delivery platforms where basically restaurants sometimes make like the majority or all of their revenues through some of these platforms. Obviously a platform of all this data, so they're nowadays partnering with an embedded lending company and then offer loans directly in the dashboard. And obviously the restaurant owner in that case doesn't even need to enter any details anymore, but sees directly, oh, okay, I'm good for 50K of a loan and so on, right? And now we're taking this a step further with agentic finance. This is maybe in the future not even limited to the embedded lending company in there, but can, in Utopia, you mentioned it, we've got a few more, maybe in a couple of years or maybe a little longer. This is not really like linked to one specific provider anymore, but there's a pre-qualified offering done by the agent in there from the right provider, and maybe that's the company that the person, the owner has never even heard about.
Yeah, exactly. And it's dynamic, based on the best deal, based on consumer preferences, not pushed based on just popularity of the brand, but based on the best deal for the consumer. That's the utopia. That's the utopia.
Exciting times, isn't it? Let's work together to make that happen.
Let's do it. 2026.
Yeah, at least it is. Just thank you. Thank you so much. Super interesting discussion. We touched on quite a different points from embedded finance, agentic finance, and a lot more. Obviously, touched the surface on a couple of them. Always love chatting with you. If there's a listener out there who wants to learn a little bit more, you publish some great analysis pieces around fintech, so maybe you can tell us where we can find them, and also if there's a way to get in touch with you if somebody wants to take you up for a more detailed chat.
Yeah, so LinkedIn, I guess this is the standard go-to. Just type in Jas Shah. You'll see a probably different face, but it is me. It's just a little bit more trimmed. And then on the Substack, Jas Shah, JASSHAH.substack.com. That's where I've got some of my deeper pieces, including the piece on agentic finance, and then probably a few years ago, a very deep piece on embedded lending. So yeah, check me out in those two places.
Amazing. Thank you so much again, and until next time.
Thanks, Lars.
Thank you for listening. And if you liked this episode, I would highly appreciate if you can leave me a 5-star rating in your favorite podcasting app. And don't forget to subscribe to my weekly or monthly newsletter. All details on my website, embeddedfinancereview.com. Thank you, and until next time.